Okay, hey, welcome back everyone. So today we're going to be doing a video on Amazon. Okay, so let's kick right into it with Amazon's growth. So we can see over the last 5 years, they have grown from 177 billion to 469 billion in revenue. That's great. Net income grew from 3 billion to 33.3 billion. That's also great. Unfortunately, when you get to free cash flow, you've got 6.4 billion. To the year 2020, you had 25.9 billion, which is nice. But 2021 was negative 14 billion in free cash flow. So let's go ahead and address that really quick. Operating cash flow was actually a little lower in 21 versus 2020, but mainly it was capital expenditures were much higher. A lot of the time when you see, this steady free cash flow increase and then suddenly it drops way off, or for example, that happened at Intel in 2021. You've got approaching 20 billion in free cash flow and it dropped off to 10 billion. Although to be honest, this is a lot worse. This is a drop off from almost 26 billion in free cash flow for 2020, dropping down to negative 14.7 billion. That's a huge drop. Part of it was a larger CapEx. And again, capital expenditure spending can be, for example, basically having to expand with a lot of new equipment and new factories. So I'm going to assume that it was probably, because Amazon keeps getting bigger and bigger and making more revenue. And as they expand, they need more and more factories for their expansion. Okay, so moving on, we take a look at the debt. We look at the last 5 years average free cash flow, multiply it by 3, and you get 33.9 billion. We want their long-term liabilities to be less than this. It is not at 48.7 billion. Okay, we also like looking at the current ratio, which is current assets divided by current liabilities. That's basically to say, if the company liquidated today, could all their current assets cover those current liabilities? Anything over 1 means they can, but I typically like to see it closer to 2. So, 1.13 here. Honestly, my review of their debt, I don't really like it. Okay, now we're going to look at the Dcf model. We need to figure out a revenue growth rate for the next 5 years. Analysts on average kind of have it at 16% over the next 2 years. I ran a compound annual growth rate over the last 5 years, which came to 21.4%. But they're so big, I don't want to say, oh, they're going to grow like they did in the last 5 years. I kind of like that analysts are thinking, 16% over the next 2 years average. We're going to go ahead and go with 15%. So we grow this thing out 15% over the next 5 years to 944.9 billion in revenue by 2026. We had to come up with a free cash flow margin in comparison to the revenue. That margin is just free cash flow divided by revenue. Now you have to excuse me as I'm looking at my paper, but if you take the last 5 years of free cash flow to get a margin and divide it by revenue, you get 3.6%, 7.4%, 7.7%, 6.7%. 2021, we cannot get a margin because it was negative free cash flow. I'm not holding that against them. I'm hoping it was just a one-time, big CapEx thing where maybe they really had to spend a lot on factories, yada, yada. Okay, so back to the model. A lot of them were above 7. I think that while giving some margin of safety still, I like 6. We go with 6, apply to all of those projected revenues. We need to get a terminal value. That's based on a weighted average cost of capital you need to get. I get it from finbox.com. And I went ahead and took the mid there, 7.2%. Got to go with a perpetual growth rate, which we applied to that as well. And we get our terminal value. We apply our rate of return of 12% that I like to do on all stocks, or a discount rate of 12%. We get all these values after applying our discount rate. Add all those values up, divide by shares outstanding, and you get an intrinsic value of 1,668.9, or just round it up to a fair value of about 1,669 a share. So, compared to current share price, that's poop. Literally, the current share price is double of that. A lot of people could look at the model and say that's bull crap. There's no way Amazon could be worth that. I do have to say, though, I applied a revenue growth rate that was only 1% under what the analysts say for the next 2 years. And it could, it could kind of decelerate after that and go much lower as it's already a very big company. But I was gracious enough to give it 15% over the next 5 years. Also, I don't feel that my free cash flow margin is out of line. A lot of those numbers were a little above 7 for the free cash flow margin. Remember, Amazon's margins in comparison to revenue are really not that great. It's just kind of part of the trade of the business. Amazon's in a business where your margins aren't going to be super high like a tech company. So yeah, I don't know. I mean, a lot of them were a little above 7. I think 6% was very fair considering that 2021's free cash flow margin was no margin. It would have been a negative margin. I certainly can't give a higher free cash flow margin just because of my margin of safety, but I also can't assume that the margins will get better for 2 reasons. One, history has shown me that their margins have never even been higher than like 8%. Like they're always under 8% for a free cash flow margin. But 2, as they continue to grow and grow and grow their revenue and expand and become the big Amazon fucking bubble they are, who's to say they're not going to need more factories, more equipment, and have a huge CapEx spending again, and potentially have a very low free cash flow margin again, or worse yet, even another negative year of free cash flow. So based on the model, the fair value of Amazon right now is $1,669. I wouldn't be touching this. Again, some people may think it's not valued fairly, but to me, the discount cash flow model is the best way to value a company. You're valuing it based on projected free cash flow. At the end of the day, a company is worth how much free cash flow they can generate. Amazon's revenues may look huge, but that doesn't matter if their free cash flow is not really high enough to substantiate the current price, and there was just negative free cash flow. So we'll have to see how that goes. Model says that it's $1,669 a share. Last I looked, they were like something like $3,200 a share. So the model definitely says this is a no-go, and it's not something I would buy based on my model and my principles of investing. Okay, so that's all I've got for you guys. I will see you in the next one. Have a great day.